Good morning and welcome to the show. This is the Weekly Jargon. I am Jose Rodriguez.
And Rohi Zachariah.
And today, Rohi, what do we got? We got some updates here on some of the local updates, some events that.
Yeah, we missed you. We had the parade on Saturday.
Yes.
So
Well, tell me about it. How was?
I think it was pretty well attended. I think Madera. I think it was like the 94th anniversary for this parade. So definitely a long-standing tradition for Madera. But a lot of people came out. Good attendance. Weather was great. We got to get shuttled around on little golf carts. The city council. So we kind of were handing out things, and it was fun.
Good,
So, yeah.
good. And you said it was the 94th, so it's got a long tradition.
Yeah.
Right, and I've attended, I think, maybe the last 4 or 5. I was on the street there, but unfortunately, I actually attended a conference that I think you were supposed to attend, and good thing I took one for the team, right? And this was our housing authority. They go to a national convention for NARO, which is the National Association of Redevelopment, Housing and Redevelopment. Again, a lot of these housing authorities, this is an advocacy group for especially housing authorities that receive federal funding, and just keep us up to date on what's taking place, how HUD has now scaled back on the amount of money, how they want to see housing in the future. Obviously, when there's a cut into funding, then that's a message well sent that most likely they want housing authorities to kind of absorb those housing, whereas the HUD does not really want to keep on the operational side of it, right? So somehow, essentially, housing authorities will have to find means to be able to get that public housing and/or the Section 8 housing choice vouchers going. But it was a very interesting. I did learn quite a bit. A refresher. It's been a while since I've attended one. Now that I'm the vice chair, obviously that's something that they encourage us to go and learn about the housing authority and its function. But other than that, then we did have, again, you said the parade. Anything else that took place here in our local city?
Local wise, I mean, there was a couple fires and stuff that were going on around town. I know we had some devastating ones. Looks like we got a couple of homes, and then obviously some businesses had some smaller fires. But I think for the most part, you leave and the city burns down. I don't know. That's all I can tell you.
Is that what it is? Yeah. So I'm glad I'm back, though.
You're back. Hold us down here.
Hold us down. So let's talk about, we've been talking about updates with the market and what have you, right?
Yeah.
Obviously, we've heard that the feds had initially dropped the Fed rate, and that created some stir, especially amongst folks that are looking to buy a home, possibly borrow money. And when it comes to housing, though, it didn't really have an impact because those pricing adjustments were made in advance of them knowing that the Fed would probably cut rates. So they improved those rates early on, and now that the Fed did cut the rates, people expected to see another dip.
Yeah.
And it may have had the opposite effect because, typically markets react when the Feds do cut rates. So we're hoping, everybody's hoping, right? They've been on the fence. I think we see a huge demand that's stored, but there's just not an incentive for it to get out there and people want to go out and buy a home. Do you have something there you'd like to share with us?
Yeah, so this was just to show active inventory. It just specifically in California, and this is coming from as far back as 2016, and you can kind of see. I think the main thing is just that inventory is creeping up. As far as active listings, and I think it coincides to what we've been seeing, which is. Things are slowing down a little bit. People aren't as over eager to just jump into a new house. They're maybe cherry picking now, or they're, like you said, they were kind of waiting for the rates to ease a little bit to kind of maybe upgrade or find a way to save money. But it's definitely, based on this chart going back to, 2016, 2018 kind of levels, which I don't know how you describe the economy during those times. Obviously, I think there was a sense of a slowdown in that time. So, maybe it's just an agreement that that's kind of where we're going. And then, I mean, to the other side effect of that is, looking at the median house price, it's not falling off the cliff. I mean, when you go back to the pricing of that house during that time, so, it's saying the median house in that time period was 520,000, but to today's value, we're still looking at well over 700,000. So that price slide hasn't happened. That, regardless of people looking for homes or the rates coming down, houses, I don't know if you want to say they're overpriced still, or this is just what the price is going to be. I don't know.
So now, are you also seeing this around like other sales, I mean, we talk about vehicles, and I know that they're having a hard time as well. More and more on these vehicles are sitting on the lot. And, I just heard about trucks that were going for anywhere between $80,000 to $90,000 still sitting in the lot, $50 a day for every truck that's there. Obviously, that's the floor financing that you have.
Yeah.
And essentially, I mean, at some point, what happens to those vehicles? I'm kind of curious as to how you deal with that. Do you flood the market with all these? Do you go to auction and I've heard over reels, people talking about like, they're going to flood the auctions pretty soon. And I mean, we've been hearing this quite often, but there seems to be another strategy where I think they see the ramifications of doing that and what's happened in the past. So it's very difficult to just say, here, let me just unload everything because we're losing money versus, holding on to it and maybe putting them in areas that probably never sell.
Yeah.
Right?
I mean, I think in the car market, if you know the car market and how it works, I think the strategy is still for them to make their money on the financing and not the vehicle, which means what you're seeing coming back is what we've been used to pre-COVID, which was, the huge incentives, 5,000 off, all these, huge rebates and stuff. Those words are getting thrown around again to kind of, again, spur that. But it's really about the financing. It's getting people locked into, when, pre-COVID, it was always like 3-year terms. That's kind of all you would use for a car. And now they're talking like 5 and 7 and 8-year terms on a car to get people into, essentially just to get them into a payment plan that they can afford. And I think some of that also plays into somewhat of the self-destruction people had is, they've maximized their paycheck at this point, and people have, they grow bored real quick, and, they don't have a lot of expendable money to kind of do something. They have to do something different, which is, okay, now I need to sell this car. I need to make something change so that I can free up some of this money to do something different. It's just a matter of, I think if you see too much of that happening, that's where you get into the panic mode of, the just tumbling and tumbling. But it's definitely seeing the initial signs that it's slowing down. So.
Yeah. And the interesting thing, I was helping my sister trying to find a home out in Turlock. She was asking me if I can look into my sources there to see through either an MLS or look through Realtor.com, right? And it's pretty simple. You can go on there yourself. And once you sign up in there, then it knows what you're looking for. Yeah. And you constantly get these alerts. And especially, this was the area of Turlock, you start seeing homes that are starting to take in certain price cuts or reduced prices, right? Anywhere from $9,000, $17,000. But again, it's because homes are sitting in the market a little bit longer, and they may have overvalued that initial price, and you're not seeing the amount of folks making these bidding wars that you had several years back. So now, I think the market's finally trying to balance itself out and saying, hey, maybe we're overpriced. It's time to bring this down. I mean, the notion that you hear that we have a shortage of inventory, I personally, this is my opinion, I feel like, sometimes we don't look at all the data, but we look at only what you're trying to sell or what you're trying to shape, right? Because obviously we have homes out there that folks in the boomer side are still holding on to, And at some point, they're holding on to them, and it's getting difficult to maintain.
Yeah.
These may be homes in the 2,000 square foot homes, and maybe single individuals living there, maybe husband and wife. But at some point, they would love to, get themselves into a different condo or something that's less of a maintenance, or maybe keep it. But because there's that stored energy, what happens when they decide to, just vacate the house? You're still building a lot of new construction, which is good. I mean, you're keeping up. Yeah, I see California starting to kind of allow for less red tape, right? You see that with the ADUs because they know the importance of this shortage or this inventory that we talk about. But overall, I still think that as demographics start showing a decline, and then you don't see the interest in the younger generations wanting to say, well, I want to buy a home. You have the highest generation that we have, which is the boomers, and they start tapering off. Then you start flooding markets again with a lot more inventory. Right now, who is buying them? Though that's the question: is who is buying them? Is it your standard families or young generation that's coming up, or is it institutional investors buying up and scraping up these properties? Again, in the rental market, they're having to provide to their investors some type of ROI, and they're looking, well, how can I give my investors a dividend? Well, let's start looking into these markets, and once you can capture a pretty good share of that market, then you can pretty much dominate the price when it comes to rents.
Yeah, and I think it's a valid point. I mean, because even the new housing, I mean, it's if you could find or have a house built that it doesn't have about size anymore. It's just if you could find a house that's, let's say, 150,000. I mean, to today, which sounds crazy. You can't. That's not even feasible here in our area. It's okay. Let's say a whole development came in with those priced houses. How much of them, like you said, how much of them would be bought up by individuals versus people looking to buy them for rentals? Because that's the struggle when you say housing inventory. There's I would say plenty of inventory, but it's not. It's that everybody's fighting for they want the bottom, but nobody's willing to give them that. And that's kind of the struggle because obviously a developer's not going to come in and say, you know what, I'm going to focus on a house of $150,000 sale value. They're not going to do it. There's just not enough maybe money in there. There's just with all the work and every effort that goes into it, it doesn't make any sense to them. But even if they did, even if they crossed that barrier, you would almost have to have some kind of, something in place to limit who could buy them. Give it to this lower end people that's what they need to focus on, affordable housing. But I don't think you're going to have that. I mean, it's still going to be. They still know maybe what that home is worth. Maybe they're getting that deal to get it at 150, but maybe 3 years, 2 years, whatever, they'll flip it for much more because it's capitalism. I mean, everybody's going to find a way to kind of make money in a sense.
Yeah.
And they'll know that these investors are maybe willing to pay that a little extra because, again, once you factor in the mortgage and everything, if I can get it below what I can rent it for, it's an investment. I mean,
Yes.
that's what everybody's looking at.
And, I think we talked about this or we touched on it a couple months back regarding, like new construction. Obviously, you see some builders that offer a good amount of credit so that you can buy down your rate. But there won't be a price cut on it. Instead, they'll give you, some money, again, to help you maybe get down to a better rate, a better situation when you come into buying the home.
Yeah.
And again, my thing with new construction is if that fits your the demand that you have for today, your need, then you're going to buy it. And we do see those. There are people that are buying new construction. Some are selling their homes. They're upgrading, and all they're really doing is they're just shifting their value to their equity to a different home. In many cases, you'll see where they buy them cash. In many cases, you'll see where they do finance a small amount. They like to liquidate their debt and then just have one payment on their mortgage. And for the most part, I can't say that the financing part is seen like, wow, these folks are not making it. They have decent income, but a good portion of that income is going to their housing. And I think this is where you start seeing folks may get into trouble later on when their debt to income ratios leak past 40%, 45, 50%, which are allowed.
Yeah.
But again, we don't know all the circumstances that are taking place in their household, right? They could have a bump in their income, but it could go the other way as well. If they lose that job or they're out of work, then the mortgage doesn't stop with you. I mean, it doesn't pause, right? You still owe it, and you may be able to modify it at some point, but at some point, you have to pay the piper, and you haven't really seen all these foreclosures that have been taking place since the pandemic, and they haven't released them out yet. But they're slowly starting to leak because essentially, I mean, you can't keep them there forever. I mean, you want to, but you've modified this loan, you've modified this other side of it, and essentially you're left with a lot of debt that no one's paying.
Yeah,
Right? So
and I think I think when you're asking like where the stored energy might be, I really think it's the young guys and these people that are living with mom and dad still. I mean, like that is essentially the next wave of people that need to break out and go buy the house because, I don't know how long it'll last. I don't know how long they have that end goal, and it could go along with other things that we've talked about before, which is like the just society and this getting married and having a family idea is kind of fading out, in the younger generation. So I think if you can see that turnaround, you may see some more of that, that growth. Because again, if I'm living with mom and dad by myself and, maybe got a girlfriend or whatever, like coming back home at night isn't too bad. But once I make that leap and, okay, now we're going to get married and we're going to have a family, I think you're going to have that desire to kind of get your own place, It could be renting, but it also could be, finding that small first home, which, like you said, everybody's kind of hanging on to because those small first homes are also the greatest return on investment when it comes to rentals, But I don't know. I think something is definitely going to have to give. I don't think we can kind of stay on this chart. And, for me, like, you were asking before we started, like, as far as interest and stuff, wherever we talked about with Robinhood and their interest rates, it went down 0.25%. Now, it's not huge, but that I know is also part of the strategy of using interest in a way that if we reduce how much we give you in the bank, you pull the money out of the bank and you put it into projects, right? I mean, because everybody, it's all business. If I'm only making this much, having it stuff, saved in the bank versus, okay, putting it into something, it kind of naturally forces institutions to start investing money into stuff, right?
Yes,
I mean, that's kind of the way it's guided.
Yes, and I wanted you had asked about like local or a Zillow or Realtor.com or a Reventure app that'll show the amount of listings within our county, right? And the bigger, I think metros would be your 93637, 93638, and then you have your 93636, which is a lot of the construction is taking place.
Yeah.
And the active listings that are showing are about 217 again with these three zip codes, right? Now, if I add Chowchilla in there, you may see that increase a bit, not as much, but 245 listings. Now, if I remove the new construction side of it, where you see the majority of these, you're going to see a different type of 124. So almost half of those, I mean, are at least in areas where a lot of new construction is taking place. I'm not saying that that's the case, because there are areas out in the 93636 area, which is our eastern part of Madera County, a newer development, 41 and 12, that you're going to see a lot of new construction, right? You have Tesoro Viejo, you have Riverstone, and you also have what they call the ranchos, Bonadel ranchos, and I think just the ranchos in general. There's two sections of the ranchos, right? But those areas out there, when you combine them, you're looking at about 120 listings on its own, right? So areas here in Madera, just removing the 936 the 93636, then you're left with our 637, 638. That leaves you closer to 96 listings. So you can see that within the city or the metros within the city, you still have a lot more listings that you had, let's say, maybe a year ago today. And obviously that just tells you that you may be facing a buyer's market.
Yeah.
And it may be a good time once the price and that payment makes sense for that person that's going to jump out there, right? Because a lot of folks are on the fence. They're waiting. You'll get a text or I'll get a call. Hey, have the other rates down to 4.6. And I go, you know what? If you have that rate somewhere, let me know where it's at because I can certainly refinance something that I have, right?
Yeah.
But it's the Fed's rate. The Fed's rates are between 4.25 to 4.5. And those are the rates that banks lend money. And obviously with mortgages, then they have to make sure that they adjust their margins to make sure that they can capture something based on risk factors.
Yeah.
So you're not going to get that rate unless you buy it down, but there's a premium to pay for that, and it could be a costly premium. Now, if you're buying a home out of new construction, this is where it may benefit you. It may benefit you. This is an incentive. So if you are in the market of buying a home and you were waiting for something, new construction is not a bad deal. Come see us. We work with builders. We can help you with that. Because they do offer an incentive in buying down that rate. So it may be worth it for you to say, you know what, I have such a small amount saved up, I don't have enough for the down payment and or the closing costs. Well, builders are incentivizing you and paying that additional for your closing costs. And part of that could be a buy down. You can buy down it permanently or you can do it temporarily. So questions like that, feel free to reach out. We'll direct you to the right channel. Shouldn't be that far, right, Roy? But anyways, this is what we're seeing right here in the local markets. These are just local updates. Again, the disclaimer is that what we see is the opinion that we make based on the information we have, which you can certainly do your own research and figure that out. We're just trying to condense it for you and bring it out so that if you are pulling the trigger on buying a home, buying a gun or buying a car, you know where to go, right?
Yeah.
Now, you mentioned, we talked about homes, but you're also seeing this also in the gun industry, correct?
I think it's in general, it's across the board that, again, and I want to say I really want to blame it on people's just, attention span in a sense of like, they bought all these, new shiny things during COVID when they had this extra money, and now they're bored of it, But, whether it's the gun because they don't need it anymore, or again, the car they bought that they realized they really didn't need, or they just want something new. I think that's where the divide is, for somebody who wants like a Corvette out there. I think that what you're seeing is it is a buyer's market because it's just cars are a really good example too, just because the minute you drive it off the lot, it's lost essentially 10,000, and then now you've drove it for the last 3-4 years, you're tired of it and you want something new. Well, naturally that used car now is worth a little bit less. And the people that were normally scooping that up, that market has shrunk, So again, it's just a combination of things that you're seeing, especially in my neighborhood, because where we live on Granada, there typically is where a lot of people like to put their used cars for sale, and it's starting to creep up. Now almost every day there's 1 or 2 cars, 1 or 2, 3 cars on the weekends. Like those are kind of the indicators that are seeing again. For whatever reason, whether it be for finances, they're just tired of this one, whatever, you're starting to see that selling happening more. And again, it's because it's not flipping as easy, just like the housing. As it sits there, people are, they're going to be more willing to take offers. And that's where we're saying it's definitely, I think in most markets, it's a buyer's market where if you're wanting that new car, now you have a little bit more room to kind of say, well, I'm going to give you 1,000 or 2,000 less than what you're asking for it. And that seller, unfortunately, because of their finances or for whatever reason they need to get rid of it, they're probably more willing to take the offer versus a year or two ago where it's, you can't even find a car and, I'm gonna jack this price up and you're gonna pay what I'm asking, and people were willing to do that.
Yes.
That model has definitely flipped. So
yes, and interestingly, we did get a comment And we got a comment from our weekly jargoneer, Abel Perez. Let me go ahead and read that because I think it's important. You know, he's seeing this from the outside. And Abel comments, you also see more families open to consolidating households and living together. Do you see this trend as a step forward or backwards when it comes to the social economic impact of the communities? That's a good question there. I think we can answer that. But the other comment that he made is the statistics are showing that Gen Z have strong saving habits and better understanding of investment than previous generations. With real estate in California yielding 4 to 8% annually, I think you'll continue to see qualified demand for housing, which I think you have a valid point. Now, a step forward, a step backwards. I'm going to take on that question because I do think generational families coming together to purchase a home is a good investment. And I said this before that if you look at a household that has maybe, let's say 5, right? You have a mom, dad, and 3 kids. And you're living in areas or in metros that become very unaffordable at points. But now mom and dad have been renting for a long time. All 3 kids have graduated, have good degrees, good income. Do you consolidate that and buy one home, multi-generational families, or do you go out and separate yourselves individually and each of you buy, 3 of you go out and buy a home, leaving mom and dad vulnerable to whatever the market is, right? So I think that's a great question, and we're starting to see some of that shift because, like it happened in these Bay Areas, I mean, a studio 10, 15 years ago would be upwards in the $3,000 to $4,000 a month. Now, but if you have families coming together, then that same studio, now you can afford a home, and you can afford that home here. So we did see that pre-COVID, you started seeing folks coming to areas like Madera when homes were going between 250 to almost 300,000. And I understand there's a stigma behind, hey, you have to leave the nest and go buy another home yourself. But see, I think that's just a narrative that's being pushed so you can go out and once you get yourself into debt, then you're into debt. Now you have property taxes with 4 different homes, right? You have the 3 children and maybe mom and dad buy their own home. You think about the amount of money that you could have together and save. You can pay down that house faster. You can save more money and invest it in different investments. I do believe that is the shift that we're starting to see, and you'll see it not as fast as you would like it to, but I think you're going to be forced to because of how market conditions are. And Abel, to your point, I do agree. You asked the question, right? But I do feel like you will start seeing more families consolidating in their household, or at least, there's going to be a shift in that because that's the only way you can afford. Yeah, I'll let you take on that.
So I would, I guess, agree and somewhat disagree. So I think to say on the grander scale, like what is better for all of us, I would say that when you're looking at items that are first off interest bearing, so house, car, any of these things that you're making payments on, I would say that the agreeing part would be, yes, if we bought the house collectively, we're bringing our incomes together, we're paying down the house faster, and we get to a point to where now we're using that income to pay for something else, meaning that goods and services. I think in general that's better because it's the economy runs on taxes. And when you're paying for that house and the property tax, yes, that's what's keeping the engine going. But then a good portion of that you're paying into the interest, which has nothing into the engine. Like it's going into the banks. That's what's keeping their engine going. But as our community, it doesn't move the engine forward. And I think that's where I've always been a big proponent of buying is great and paying it off is even better, and then using that money to keep it going. Buying the stuff. I mean, I hate to say stuff is that's what has to keep it going.
Assets that have a good rate of return and some future value.
Yeah, because when you buy, like for instance, that car, right? Like, okay, we got that one chunk of sales tax because you bought it and it moved the engine one little step. Then after that, there's nothing that comes to us as a community from that car. Okay, yeah, gas and you're paying your DMV tax, but that doesn't move anything, right? I mean, maybe when you go to AutoZone or wherever and you buy that little bit of oil, okay, there's some extra sales tax generated. But if you bought that car, you paid it off, and then now you say, I have this extra cash, and now I'm able to just do things. I'm able to go eat out a little bit. Maybe I'm able to go and buy that extra TV that I wanted. Like, those are the continual sales taxes that we need to keep everything going. It's just that circular action that just keeps, give you money, the money keeps coming along. That's how economics work. And what I'm really worried about is where we are now. We've gotten to this stalemate where we bought all these things, and that's why we had all these grid sales numbers leading up to maybe the last year or two. But now we're in this gridlock of, well, I can't buy the new car. I can't buy the next house. I don't even have any extra money left to buy all the things I need. So I'm cutting back on that. And that's where I think, we're going to start seeing, especially at the city level, this diminishing like taxes, like the money that we work off of is going to slow, which means that the businesses that are also running that are going to start seeing, everything slow. And that's where the worry is of the slowing down of this engine. Something's got to give.
Yeah, and I think in good, I'm not saying good accounting or good projections of any funding should include these hypes that we have, right? Because, if you look at it and you're projecting just a year out, I mean, we do project several years out. But again, when you have these things like a flush of money coming in like we did through COVID, I mean, now you gave people all this money, all this stimulus money, and then you stored it for a little bit, right? Because you wanted it to come out explosive, right? To show numbers of growth, because we did. I mean, for a while there, we shut down everything in hospitality, everything that theme parks and what have you. They made modifications, but nevertheless, it lost some revenue. Some closed down. So as soon as you open the gates, then everybody's out, and I think the everybody's out attitude was like, well, this is not going to end. But it was a trickle down helicopter money that just we had, right?
Yeah.
And I don't, I think this is where financial literacy becomes very important. Is I think they anticipated for local economies to take in these amounts of sales tax, the growth that we had. But we also have to be smart to think that, hey, this isn't going to last forever. This is going to be a wave that we're going to see, or a curve that we're going to see, but it'll have to taper at some point and start coming back down to reality. And we're starting to see things come back to what was pre-COVID. So I think it's important for us to realize that and factor that in what we're doing, because when it comes to a city, and this is me just looking out, right? I'm saying, okay, I'm in a business similar to that, because in my world, it's either you sell, you do loans, or you don't get paid, right? So if the economy is good, where homes are selling, refinancements are good, then I'm going to do good.
Yeah.
But I have to keep in mind that, especially if you've been through this, and those that haven't been through it, they're probably going through their first experiences. Well, wow, why haven't I sold a home? Why haven't I closed a deal? And granted, there's some really high achievers that are going to do it no matter what. They're going to find their niche where they're going to become really good at it.
Yeah.
But the other percentage, maybe 70% of the ones that just started, are starting to see markets that are very competitive, because if I'm an experienced loan officer and I'm taking the majority of the market share within my community, then what leaves that? What you're not taking the amount that you did when it was really good. You were closing maybe 4 loans. Now you may be closing 1. Is that enough?
Yeah.
So you have to factor for those ups and downs. And I think we had shown a chart of, and I put this up, Rohi, because I think you had brought this up at one time, right?
Yeah.
And dips, highs and lows and midpoints, and look out for these areas, because they will happen.
Yeah.
And in my world, that's exactly what it is. I had to have at some point say, man, that's a lot of sugar coming in. I'm assuming that at some point this is going to end. So I got to start storing, like people store their grain, because it's going to happen. And if it does, do you want to be prepared? This happened to some of us folks that went through it in the crisis of 2008, the housing crisis. And it left us like, whoa, now what? And it left us scattering for scraping by, making sure that we can make ends meet.
Yeah.
So I do feel like when it comes to sales tax, like to your point, I think it's important to project out and also factor in these phenomenons that take place that shape the curve. You know, it says it's a peak. We're going to see an increase in sales tax over the next 4 years because the flush of money is going to create our local economies are going to get crazy with all this money. But once they tighten the money, which they typically do, then it means
Was it lefty or righty?
Yeah. Well, I mean, yeah, you're right. So then you'll have that issue where everything's tight. Everything's tight.
Yeah.
And then you start looking for indicators. Are we seeing a high unemployment? Because if you do, then the feds are starting to get worried.
Yeah.
Hey, we may be dipping into a recession, and they have tools for that. Let's start throwing some more money out there. Let's start making it easier on the rates.
Yeah.
Let's start making it more make credit more accessible to people so that they can go out and spend it again on things that they probably don't need.
Yeah. Well, I mean, that's the point. I mean, if you want to bring up this one here, this is the used cars prices, you know, and this is just going back to 2016. And I think it's what people are not seeing. You know, we kept hearing, oh, the inflation rate of, you know, almost like single digits, maybe 10%, but the numbers are pretty, I mean, they're pretty out there. I mean, it was almost a, you know, 200% increase that we saw in the used car market. So there is definitely a gap in where we were on a very, I would say, consistent average to where we are now. And that's always the argument, is the cost of doing business. Either they have to agree that it's gone up 200%, or this numbers have to come back down. You know, I mean, it doesn't make sense to, again, have, and these are just indexes, but to have an index of 140 and then all of a sudden say that the new index of about 200 is acceptable. Like, we're just going to see this forever be the new index. Like, it's just again a key indicator to some of those that, you know, maybe we are still overpriced. Maybe there is still some room for things to come back down. It just depends on where you are. If your car is breaking down and you need a new one, it's still better than it was 2-3 years ago. But if you can hold on and keep that car running maybe another year or two, maybe it'll be even a better situation. That's the hard part to predict, because, like you said, there's so many factors. The government can do so many things to cause this artificial, again, rush of people just spending money where they don't need to. So
yeah. Well, this kind of wraps up our weekly jargon report, right?
Yeah.
Abel, if you're out there, we miss you. Come on back. I know your job here has limited you from coming out here, but we'll try to make some adjustments here on the week so that we can see him back. We certainly miss your comments and the content that you bring. So if you're hearing us, we'll hope to see you soon. Meanwhile, Rohi, anything we want to wrap up with?
No, I just
anything special happening this week here?
Oh, this week? Oh no! But next week we'll be gone. We'll have we got our training down in LA, so that's something to look forward to.
Good. And as a new council member, I think it's a great conference to attend, because not only does it give you insight of what's going on in the legislative world, but also in the governance and how you want to work with your local fellow council members, how to work with your city manager, and then everything from policies to certain latest technologies that are playing out to help cities grow. Whether it's in accounting, public works. Some digital apparatus is now taking over the world, and you'll see a lot of that through their. They have these what do they call them? The booths where everybody goes out there, vendors, and believe me, there's quite a bit, and you always walk away with something new that you bring back, and hope to implement working alongside your colleagues there. I think that'll be great. So good for you. Look forward to hearing from you and how that went. Hopefully next week.
Yeah.
You won't be able to chime in.
Yeah.
But the week after, we'll go ahead and make sure we get something going.
Yeah.
And with that, Rohi, I think we're going to wrap it up. Again, thank you for watching. We look forward to talking to you next week. If you like this show, like, share, subscribe.